Welcome to Personal Finance for Long-Term Investors, where we believe Benjamin Franklin's advice that an investment in knowledge pays the best interest, both in finances and in your life. Every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Hello and welcome to episode 112 of Personal Finance for Long-Term Investors. My name is Jesse Kramer. By day, I work for a fiduciary wealth management firm helping clients all over the country. For more details, you can go to bestinterest.blog/work, and the link is in the show notes. And by night, I write a blog called The Best Interest, and I podcast here on Personal Finance for Long-Term Investors. I help busy professionals and retirees avoid costly mistakes and grow their wealth, and I do so by simplifying complex ideas about personal finance, from investing to taxes to retirement and beyond. And today, I'm really excited because Peter Lazaroff is back and will be joining me. Peter is the Chief Investment Officer at Plan Corp, and he's the host of the Long-Term Investor podcast. Peter is routinely recognized for simplifying complex investing and planning issues for clients and for listeners. He's been repeatedly named a top 100 U.S. financial advisor by Investopedia. He's always a great resource for teaching people about investing, and you'll see that today simply through the frameworks and explanation that he provides. Peter first joined me back on episode 77 of this podcast. Go ahead and listen to that one, and now he's back for round 2 today. As usual, before Peter joins us, I want to do a quick review of the week. A little bit of drama because this is a 3-star review, not a 5-star review. But listen, critical feedback is awesome. So please bring on the feedback. And if I don't deserve 5 stars, that's okay. There's a chance that MJV92314 might have fat-fingered the wrong number of stars, or he or she might just be a good critic. So the 3-star review, clear, straightforward personal finance info. Thank you, Jesse, for your excellent podcast. I just discovered it and have listened to about 5 episodes. I appreciate that you don't have chit-chat and superfluous dialogue about your dog, your breakfast, or anything that's not related to your topic. You have no fake or forced laughter during dialogue with your guests. Ha ha! That's a good one. You have no unrelated banter with your guests, your excellent speaking skills. Thank you for not excessively saying like, sort of, or kind of. I will say now I'm a little self-conscious about that. And you keep it clean. Cursing adds nothing to an informative topic. I f***ing agree with you. Your topics are timely, informative, and helpful. I appreciate you keeping the conversation focused. Thank you. Well, you're very welcome, MJV. And listen, if your stars are precious to you and you only save your 5-star reviews for that 1 in a million podcast, no worries. Your written review was very kind. I'm happily going to send you a super soft t-shirt. Drop me an email to jesse@bestinterest.blog and I will get you hooked up with that t-shirt. That mother t-shirt. And listeners, if you have questions I can answer, especially for a future AMA episode and Ask Me Anything episode, send those questions to jesse@bestinterest.blog. Before Peter joins us, I want to read a couple fun articles to you that are going to be somewhat related to what Peter and I talked about. The first one I wrote recently in March of 2025, and it's called Are You Not Entertained? Do you know that scene in Gladiator where Russell Crowe's character, Maximus, he yells to the crowd, he says, "Are you not entertained?" I'm more interested in Maximus's next line, though, because he asks, "Is this not why you are here?" If you don't remember the movie, maybe you haven't seen it, Gladiator, Maximus, Russell Crowe, it's one of his initial forays when he gets thrown into the arena and he has to battle as a gladiator for the first time. And the audience certainly came there to see some violence and some death. And specifically, the plan was for a bunch of local gladiators, heavily armored, fully armed, to kill off some foreign slaves, including Maximus. But because Maximus is the protagonist and or because he's a highly trained Roman legionnaire, he turns the tables on the local gladiators. He kills all of them single-handedly. And the crowd is really caught off guard because they did not come to see that kind of a turnaround, and they go silent. And that cues up the immortal lines from Maximus, "Are you not entertained? Is this not why you are here?" Maximus also throws his sword at the box seats, which is a real power move. But the point is, the audience came to see violence and death. They just hadn't expected it could be delivered in quite that way. And that frustrates Maximus. Did they expect every slave just to get slaughtered without fighting back? What terrible expectations. Does a chef expect a Michelin star without some burns or some knife slips? No. Does a traveler expect every eye-opening experience without a single delayed flight? No. And does the long-term investor expect their portfolio to compound for decades without times like the tariff tantrum that we had here in 2025? I say no. I get it though. Loss aversion is real. It impacts all of us. It's natural to feel anxious when markets react to world events, to wars, to politics, to tariffs. But it's crucial to recognize that those external shocks have always been part of investing history. We've had world wars and pandemics and oil crises and banking explosions, inflation run amok, et cetera, and yet here we are. The nature of long-term investing is one of volatility, of ups and downs, and the ups are easy, they are great. The downs, if we're not careful, can be really challenging, and you might have felt that challenge here in 2025. That volatility, though, that is a feature, not a bug. Again, that is a feature, not a bug. We want to see volatility. We want risk to be involved in our investing, at least in some part of our investing endeavor, because without that risk, there is no compensatory reward. There's no point to investing in the first place without risk. Is that not why you are here, Maximus, right? Having a little bit of risk, that is why we are here. Yet often people get stressed or scared, or they make drastic changes in their portfolio when faced with volatility. Such a reaction is this glaring red light to me that suggests that the investor's expectations were not adequately set. If your monkey brain is screaming, get off this roller coaster when you have a little bit of volatility, we need to ask, why did you get on that roller coaster in the first place? Were you expecting a smooth ride? Such investments do exist perfectly smooth, but there's no real upside to them. There's no real reward. It's hard to set new investing expectations in the middle of market chaos, just as teaching fire safety while the smoke alarm is going off, that's pretty hard too. Instead, we run real fire drills during the safe times to ingrain the appropriate reactions in everybody. We don't run fire drills in the middle of a fire. We run them during the safe times to ingrain the appropriate reaction and approach. And similarly, we should be setting investing expectations during the calm or positive market times to ingrain how we should be reacting now. I know this episode's going to come out in July, and right now I'm speaking to you in about mid-June, but we've fully recovered from the volatility of April. So if April scared you, I hope you didn't try to reset things in the middle of the fire drill of April. But now that things have gotten back to a calm or even a positive market, now might be the time to think about how you reacted. And if you reacted in a pretty negative way, now that it's calm, you might want to run a fire drill now and determine if you need to reset your investing expectations. You don't have that luxury in the middle of a fire drill. If the next time you find yourself in a fire drill, and one of the second article I read today will be about that, but the next time you find yourself in the middle of a fire, I should say, in the middle of volatility, in the middle of panic, a few things that I called back in April, I called them the mid-fire fire drill. A few reminders, if you will. The first one, markets don't go up in a straight line. They never have and they never will. Volatility is the price of admission for long-term returns. If you're feeling uneasy, you need to remind yourself this is why investors get rewarded over time, because they endure these kinds of ups and downs. This is why you're here and you must endure too. The second reminder, this is why we diversify. Stocks aren't enough. Bonds play a role. International stocks are crushing it this year. Real estate alternatives can have a place in your portfolio too. The third reminder, you need to zoom out. Short-term swings can feel dramatic, but the market has consistently trended upward over decades. If you pull up a multi-decade chart of the S&P 500, the former dips, the former crashes, the former outright panics now seem kind of small in comparison. Every single one of them felt scary at the time. Yet, over time, the market has recovered and moved higher. The fourth reminder, focus on what you can control. You can control your time horizon. You can control your behavior. The quote that I like, it's more of a philosophical quote, is you can't control the waves, but you can learn to swim. And we all need to learn how to swim. And the fifth reminder, remember your financial plan. Why did you invest in the first place? What do you own and why do you own it? A well thought out investment plan accounts for volatility before it happens. If you don't have a plan, now is a great time to create one, ideally one that helps you stick with it when things feel uncertain. The world is a volatile place, and when things get volatile out there, and by there I mean like outside the markets in the real world, when things get volatile out there, I too grow concerned. But when the market gets topsy-turvy, I say to my inner Maximus, yes, this is why I am here. And the second thing I want to read to you today, listeners, inspired by a cool Jason Zweig Wall Street Journal article from a few years ago. This is beginning of 2022, where like the worst of kind of the COVID, not only the COVID market panic, but a lot of the worst of the COVID pandemic was over with. But 2022 was also the start of this interest rate shock, and markets were kind of doing some wild things starting at the beginning of 2022. And so inspired by Jason Zweig, I wrote myself a letter for when my portfolio crashes. And the article, I called it Break Glass in Case of Market Crash. And literally, it's a letter that I wrote to myself. Jesse, You knew what you were getting into. You knew this could happen, and it's okay that it did happen. Your goals are big and your timeline is long. That's why you signed up for this risk-heavy portfolio. 60% of your assets are in the stock market, and you knew the stock market could get cut in half. It's dropped like that before, and surely it will again. You knew the recent market felt pretty frothy, especially after the COVID-related stimulus, but you also knew that selling your stock position would have been short-sighted. Rather than sell, you've been rebalancing every 6 months. You've been selling overpriced assets and buying underpriced assets. That's the smart thing to do. You knew that bonds were in a tough place to park your money. Yields were pretty low. That's why your allocation varied between 10% and 15% in bonds. But you also knew that all asset classes ebb and flow over years and decades, just like a good quilt chart would show us. Your bonds aren't there to make you rich. They provided some diversification and a pool from which you can rebalance. You knew cryptocurrency could be a giant bubble, but you also convinced yourself that blockchain technology might have something to it. You balanced these opposing views by following John Bogle's famous advice to limit your sandbox, to limit your play money to less than 5% of your portfolio. You chose a percentage even lower than that, and you split that tiny fraction between Bitcoin and Ethereum, which, okay, at the time were considered the two powerhouse cryptocurrencies. I guess the idea is if you're going to drink moonshine, you should drink the good stuff, but you should definitely take a small sip. And quick aside, listeners, if you're paying attention at home and adding up my portfolio percentages, you'll realize I'm not even at 80% yet. The difference is because when I wrote this article, rather than only focusing on my portfolio, I also added in the value of our primary home as part of our net worth, and that's the other 20 to 25%. Okay, back to the letter. You designed this portfolio with intention, and this outcome, a crash, was always one potential outcome of that design. And so the market crashed and you feel bad. What you shouldn't do is suffer the malady of results-oriented thinking. Saying, told you so, isn't justified here. You did your research, you followed mostly best practices, maybe cryptocurrency is the outlier there, and you executed a plan that you believed in. You made a smart bet with good odds, and the dice haven't rolled in your favor recently. Does that mean it was a dumb bet? No, it doesn't. As Annie Duke writes in the book Thinking in Bets starts with recognizing that there are exactly two things that determine how our lives turn out: the quality of our decisions and luck. Learning to recognize the difference between the two is what Thinking in Bets is all about. In your case, Jesse, the right choice led to a bad outcome. The next part is painful. You've got to make the right choice again, even knowing it didn't work out perfectly the first time. That right next choice is to continue learning, to implement lessons learned, to continue rebalancing your portfolio, and most likely to continue holding the same asset classes as before. The one exception would be if crypto turns out to be a complete fraud. You should probably just stick to more traditional asset classes. In other words, stick to your guns with a small allotment for adjustment. Is that insanity? Are you suffering that trope of insanity is repeating the same actions while hoping for a different outcome? I say no. When the poker player goes all in with a pair of aces, we don't scold her for losing on an unlucky flop. We commend her for making the right decision with the information she had. We recognize the role of bad luck in that outcome. This untimely market crash is the same. It sucks. It doesn't feel great. But go back and reread Bogle, reread Burton Malkiel, reread your foundational books. You played your hand well. This bad luck was always a potential outcome. As insane as it sounds, you've got to stay the course. Good luck, dude. I'm pulling for you, obviously. And that's my letter. And if you haven't written a letter to yourself in case of market crash, if you haven't explained to yourself why you own what you own, and if you haven't explained to yourself what your range of potential outcomes could be, both in the short term, the midterm, and the long term, that might be a pretty interesting exercise for you to do. Here's a quick ad, and then we'll get back to the show. I love getting your questions, and some of you ask me questions about the wealth management firm I work for in Rochester, New York. Others ask about the Best Interest blog and this podcast, Personal Finance for Long-Term Investors, which operate without advertising, without pushy sales, and with no paywalls. How can the blog and podcast stay afloat without me dumping my own money into it? Well, to answer both those questions, I want to point you to episode 78 of Personal Finance for Long-Term Investors. I intentionally recorded episode 78 to shine light on those topics and inform you how you are actually helping and can continue helping these projects carry forward. So if you've ever been curious about the business of my blog and podcast, or if you're curious about my day job in wealth management, please check out episode 78 and let me know what you think. And now, without further ado, I want to welcome Peter Lazaroff onto the podcast. Again, Peter is the Chief Investment Officer at PlanCorp, which is a independent registered investment advisor out of St. Louis. And he's just got a great knack for simplifying the complex investing and financial planning issues. I mean, similar to stuff that I talk about. I really look at Peter as a great peer, probably a peer who's, 10 years ahead of me career-wise and someone I aspire to, because I think what he's doing is awesome. Just a great resource for teaching people about investing. And I think you'll see that today through the frameworks and the explanations he provides. So again, here is Peter Lazaroff. Peter, it's messy out there, man. We've had an interesting year so far. We're recording in mid-June. This will probably publish in mid-July. We started on some highs. Boom, April hit. We had some lows. Now maybe we're back towards highs, but still, one thing I'm struck with is there's this big difference between short-term signals and long-term direction when it comes to investing. I'd love to maybe start with just how have you felt and what are some of your thoughts about how 2025 has been so far?
Well, first of all, Jesse, thanks for having me on the show. And actually, since I know you don't use video, but I can see in the background this giant box behind me. You know how 2025 is going? It's going great because I'm cleaning out old stuff. And there's actually a box of books of Making Money Simple. So my first book came out in 2019, Making Money Simple. And I was just telling you before the show that I'm putting the finishing touches on my next book, which is called The Perfect Portfolio. But when I was on last year, your audience reached out. They were fantastic. And so what I am going to do is if your audience goes to peterlazaroff.com/free book, I'm pausing. I think it's free book, not book. We'll put a link in the show notes. I'm going to send you one of those books that's sitting behind me. There's a box of them. I think there's like 32 per box. Somebody pulled them up. The postage date on them is September of 2020. So they've been sitting in storage. Nobody knows where they came from. I didn't tell you that I was going to self-promote and drop that, but now that I see it in my camera view, you ask, how is 2025 going? Man, think about being a long-term investor is that when you go into a year, clients are always talking about a few things, and tariffs were certainly on people's mind. The election results had just come in, and I would say in any presidential election, my experience has been that half of people are very upset and half of people are happy. And I think a lot of people who are upset were saying the market is going to crash. I don't like some of the policies and things that are being said on the campaign trail. And lo and behold, I wouldn't call a 20% drop a crash, but we had a near 20% pullback, and you have people who feel validated. And I can't tell you how many times in my career I've put up slides showing that who is president does not impact the stock market, or a political party does not impact the stock market. So one frustrating part about 2025 is me now realizing in about 3 years when we have our next election that when I put up those charts, people are going to say, well, what about the tariffs that Trump put out there? That did happen. I suppose that validated. But as you mentioned, we're already back. It's a great reminder that the market is going to fall 10%, 20% with a pretty surprisingly large frequency. And the story is always going to be different. But the most important thing that I was talking to clients about and talking to employees and friends and family is earnings. And yes, in the case of tariffs, which, by the way, by the time this airs, that 90-day pause will be close to expiring. And so there'll probably be more headlines related to it. Here's the thing is, no matter what the tariffs are, do you think McDonald's is going to try to sell less cheeseburgers, or Coca-Cola is going to try to sell less Coke, or the Ford's going to try to sell less cars? No, they're going to try to sell as much of their product no matter what. Will there be more obstacles? Have the rules to the game changed? It's like if we got out a board of Monopoly and we've been playing by the same rules that Monopoly has always existed with, and suddenly we change some rules, it's going to change your strategy a little bit. But when you invest in the stock market, you are betting that CEOs like money and that shareholders will demand that CEOs maximize their value. So 2025 has been like a full long-term market lesson all wrapped up into 6 months. It'll be really interesting to see what goes on with tariffs, what goes on with the spending bill. Yeah, that was a really long answer to your question. So let me take a breath here. What are you thinking?
It's a good answer. And in fact, I want to play devil's advocate here on behalf of the listeners, but also, Pete, on behalf of client conversations that you and I have both had. Maybe someone's listening right now and go, okay, we don't know what will happen over the next month between when we're recording and publishing. But let's say the S&P stays about where it is right now, which is close to all-time highs. Essentially, we haven't really lost any ground on the year, but Imagine someone says, I hear what you're saying, Peter. McDonald's will keep on trying to sell cheeseburgers, but we saw something this year where one politician was able to push some policy forward and then pull it back and then kind of push it forward and pull it back and just whipsaw the stock market. And that has fundamentally shaken my faith in long-term investing. Is there any merit to that argument, or just what's your response there?
I think there's merit to that feeling. The feeling is valid. Feeling concerned, feeling worried, feeling uncertain, all valid, all normal. Nothing wrong with that. When you take a step back and you think about why we invest in the first place, I always go back to really the first principle level is we invest because we're trying to grow our savings faster than the rate of inflation without taking undue risk. And so what is undue risk? Well, yes, there is risk in that concern and that feeling that one individual specifically is exerting a lot of influence over the short-term fluctuations of the market. There is a risk that the market will fall 10% roughly on average every 12 months, because that's what it's done historically, and fall 20% every 3 to 4 years on average, because that's historically what it's done, and fall 30% or more about once a decade on average, because again, that's historically what it's done. I generally think that when I'm investing in stocks, I'm going to assume that we're going to have downturns with a similar magnitude and frequency as we have in the past. And so to me, that's not an undue risk. That is risk. And it is okay to be uncomfortable with risk. It's okay to be even more than uncomfortable, to be afraid. I think that's why some people hire an advisor. I feel like I operate with robot-like execution with clients, but even on myself, I don't. And let me give you an example, Jesse. So during this downturn, I don't have a lot of cash. I don't keep a ton of cash on hand. My biggest asset is the firm that I'm a part owner of, Plan Corp. I fund all my retirement accounts. I fund my health savings account. And so the best thing I could come up with was directing my entire paycheck to my 401k. So basically speed funding my 401k while the market was down. And typically I wait to fund my HSA until December, when I get my year-end bonus and I have a little bit more cash. But basically I just took all my paychecks and just put them right into the market. When you do it in a 401k, as your listeners and you and everybody probably knows, it goes right into the market. My HSA had to make a couple stops. And Jesse, we're recording this on June 10th. The cash in my HSA is still not invested. I am human like all of the rest of you. And all of the systems that I have in place for myself that generally mean that money's getting invested right away don't apply to my HSA, in part because of the way the account's set up, and in part because it requires me to click a button. Now, is it because I'm afraid? No, if I'm being perfectly honest, I saw a little spike, and in my head I said, well, surely, most bear markets don't resolve themselves this quickly. And here it didn't. Now, what am I waiting for? I've not publicly shared this story. I guess by December, when I normally would have made the contribution, I will definitely do it by then. Maybe I'll do it right when we get off the call. In fact, mark my words, I'm going to do it right when we get off the call. My 2025 investment will get invested. So by the time you are listening to this, dear listener and the audience, it will be done. But my point, kind of going all the way back to your concern, was I think it's valid. It is very human. We all feel it. And when people like you and I are telling you what's best, what we have set up for both your clients, or we have set up for my clients, is to do it without emotion and to do it without human judgment and follow processes and financial theory, because the long term, those things turn to work out pretty well. But the problem with the long term is that it is an eternity to live through in the moment. And so for the people who still feel uncertain and shaken about what has happened and what might happen, I will again reiterate for the third, fourth time in the past 5 minutes, totally normal. Just remember, why is it that we invest, and what is a risk that you get compensated for, and what's a risk that you don't? You don't get compensated for trying to time the market. You don't get compensated systematically, at least, for trying to pick exactly the right security. So even though I poorly timed the market here, I'm going to go buy the single fund that I own that's 100% stocks, globally diversified. I will make no choices other than what my predetermined plan is. And you go forward that way. And it can be one of the crazy things is you look back at every drop and it seems like an obvious opportunity in hindsight, but it's always seems like a risk in the moment. And so find a way to turn what feels like a risk into an opportunity, because I can assure you that when you look at one of those long-term charts that goes up and to the right and has all the headlines, this is just going to be one of those headlines that shows up on the chart of long-term returns. Despite all of these headlines, this is going to be on that chart. You just wait. Give us a year so there's enough room on the chart to include it, and it'll be in every history book like that.
You touched on a few things there, Peter. Well, first off, I want to say that your quote, that part of our job and part of any investor's job is to grow their assets faster than inflation without undue risk. I'll be honest, I've stolen that one from you before and used it. That is a fantastic explanation of the reason why we're all here in the first place. It's not to become gajillionaires and die atop the greatest pile of gold that we can. It's to simply grow our assets faster than inflation, but also keeping risk in mind, which is huge. I want to dive more into behavior, because to me, when I've seen what's happened so far this year, one of the biggest risks we all face as individuals is that risk of overreacting. It's that risk of mistaking volatility for some sort of signal that we need to change our plan. And I'm pretty sure, correct me if I'm wrong here, I think I listened to a podcast episode that you put out earlier this year where you said something akin of like, there are some times actually where you suffer volatility, maybe for the first time as an investor or the first time as a retiree, your portfolio really takes that first big drop. And you learn that maybe your risk appetite isn't quite what it is. And changing your portfolio actually is the right thing to do. It just so happens that it was also the right thing to do before the volatility hit. You just didn't realize it. Can you dive into that logic a little bit?
Yeah, it's interesting. And I don't think it's something that I would have said at the start of my career nearly 2 decades ago, when my only education was really that from a textbook. In reality, when you're dealing with humans, you can't take the human nature out of humans. And I think a lot of times as we work with clients, it's not just to be a robot fact machine. I mean, in many instances, we have the unique privilege to listen like a therapist and ask questions and dig deeper. What I've come to learn as a result of that is nobody really has a problem with the volatility itself, with the down market. You will sign an investment policy statement before we invest a client's assets, just like any other good advisor will do. And you'll say, hey, the portfolio, the worst 12 months it's had, like if you had $1 million, would you be comfortable losing $360,000 of it or whatever? And you're like, yeah, of course. I really think people believe that. And that's how we set that stock bond mix. But what I've come to learn is that while people can handle the volatility, they can't necessarily handle the narrative. And I think that's a very different piece of the pie that has given me a different appreciation for what my job is as like your portfolio Sherpa. I'm not just here choosing investments. I'm going to think a lot about the experience of investing. And if that means that we didn't dress you warm enough for the winter, we're going to get you an extra layer of coats, which in this case, I guess, are bonds. I don't know. This is off the cuff here. Or if you're too hot, we're going to get you some swim trunks. In a perfect world, the market's down and you find out that you're too conservative, that like you're in your 70s and you have more money than you're going to need. And so you're going to more closely align your portfolio with the time horizon of those who are set to inherit it. And you get more aggressive in a downturn. But if you're approaching retirement or having just entered retirement and you realize that you can't handle the downturn, yeah, it's not ideal to sell while markets are down, but it is much better to adjust an allocation a little bit than to go to all cash. There is no doubt that getting entirely out of the market is the wrong move. Naturally, when people want to make such a move, I remember in the years 2007, 2008, 2009, that was a very common conversation. I want to get out of the market. Everything is going down. Everything's going down in flames. And we used to call them jumpers, like they're jumping out of the market, not jumping off a building, but used to call them jumpers. And like I was working in an office that had no individual offices. We were in a totally open floor work. Like all the founders and partners of the firm were dispersed equally among us. And so you could hear all the client calls. And that to me was like a very different vibe, like trying to make sure you don't get all the way out of the market. Whereas if somebody's a 60% stock portfolio and they want to go to 50-50, in the grand scheme of things, it's not that big a deal. If it will help you sleep at night, it's not that big a deal. And I'm going to reluctantly say, oh, by the way, if you really want to make a change that's going to make a real difference in the long term, you should probably make a move by more than 10%. But I don't know that that's necessarily what I want to see people do. I recognize that 10 percentage point changes aren't going to really change your trajectory that much. And so as a result, if it's really going to help you sleep at night, that's fine. What I like to do in those instances is document it really for the benefit of the client. So if you think like the best traders in the world, and we're definitely not traders, but they keep journals, they have their reasoning why, like what would make them change their mind, and just like create an archive of like, hey, this is what I heard during our conversation and why you want to make this move. And the reason you do this is because if it fast forwards 6 months or 6 years and the sentiment's totally flipped, we have to make sure that we have a clear roadmap of why we got to where we were for making these changes. You're allowed to make changes with your portfolio. In a perfect world, you pick one strategy and one allocation, you stick with it for as long as possible. But at the end of the day, if you can afford to make that change, yeah, you're right. I think I've become a little more lenient in my sentiment around that issue.
Yeah, you reminded me right there. There's this Cliff Asness story that maybe you've heard before, where I think it's his aunt or his great aunt. I think she like lives in Australia, but she travels back and forth to, I believe it's the USA pretty often. And she knew that Cliff Asness, if you're not familiar, he's a hedge fund guy, right? And so she would ask Cliff, she's like, hey, I know you do these currency trades or whatever it is you do. When's the right time in any given year when I need to move my Australian dollars to US and US to Australian? And for years and years and years, Cliff was like, I can't tell you that. Like, I can't zoom into it this specific day. And she interpreted that as like, you're just withholding information from me. Like, you know the answer, but you're withholding from me. And so eventually he said he kind of got this better EQ, emotional intelligence. And he'd say like, you know what, Aunt Cindy, next Wednesday, you should do it next Wednesday. Because she got the narrative that she wanted, which was she was getting expert advice. And Cliff realized it's all just arbitrary anyway. So telling her next Wednesday isn't any worse than telling her, I don't know. And there's a similar, not maybe exactly the same, but there's a similar idea that you just described there, Peter, which is, you know what? If someone is 60-40 right now, they feel like they have too much risk and they want to go, going 55-45 or 50-50 makes them feel better for the rest of the year. Now, okay, all else equal, it's probably not a coin flip. I would rather they stay 60-40 if that's better for their plan. But if it does help them sleep at night, it's close to being a coin flip, and I'm okay with that change. And it's a lot better than saying, a month later, screw you, Jesse, you told me I can't change, and now I'm going all cash, like sayonara. It's a much better outcome. So there is this interesting gray area. I also wanted to touch on the narratives idea a little bit more, because one hard thing that I find, Peter, is I'm certainly not a fake news kind of conspiracy, they're all lying to us person. But at the same time, I do realize that if we consume too much news, whether that's cable news or just reading, Google algorithm feeding you the news that you're already reading, it is easy to convince yourself that the narratives will start driving your portfolio decisions. And so one of my struggles, or just one of the hard parts I find about answering reader or listener questions or answering client questions, is when they say, but haven't you been paying attention to the news? Everything is going badly. And that's been the case. It was the case when President Biden was in office, and some people were saying everything is going badly. And now it's the case when President Trump is in office and everything. And it really is largely narrative driven. So yeah, again, maybe I'm beating a dead horse here, but what do you say to the client who's addicted to the news and is telling you that you're wrong about the world?
Yeah, I experienced those same conversations, and I try my best to always, anytime the conversation comes up with a concern, the first question I ask is, how do you think that impacts earnings? Because at the end of the day, the stock market tracks earnings so closely, like shockingly closely. I mentioned working on this book. I have a whole chapter. It's become such an important idea to me that it's almost an entire chapter. And there's some charts in there that you'll be able to see like how closely it's all tracked. And the economy and the stock market are not the same thing, because the economy, they're real people losing their jobs. Businesses, they have access to sell to the whole world. Now, are things worse because of a set of policies than they would have been otherwise? Perhaps. I think that's a logical concern. But does that mean that earnings won't continue? Let me put this a different way. So I own, a stake of the business that I'm in. I'm not selling my business because of the way the world is going. We're trying to figure out as a business how to earn as much money as possible. all of my clients who are business owners are doing the same thing. There is no policy. The front end of my career was mostly with doctors. When I came to Plain Corp, it introduced a lot of business owners into like the type of people I worked with. And I've never, ever, ever met a business owner who says, I'm going to just sell my business because, the economy's terrible. I'm just going to sell my business. What is it that we all think we're doing in stocks? We own businesses. And that's where it's a narrative correction. What's so interesting is so many times people give me all these reasons that things are bad. I'm like, those are all facts, but they're not necessarily relevant. That actually comes up with the investment case for a lot of things. Like, we don't have to go down a huge rabbit hole, but like one topic that I really struggle with, for example, are private investments. Like maybe they're useful. If they're free, I'm all in, but I don't think they're necessary. And like the primary narrative for using them are all facts. I'm just not sure they're relevant. When you come to things on policy or the economy, all facts, all something that I think might impact you in real life. I think especially in the last 6 months, the thing I've kind of been reflecting on is, hey, this is the sort of thing that's going to affect our everyday lives, but it's, long-term, not really going to affect the way that businesses, in the sense that they try to make as much money as they possibly can. If we get to a point where businesses stop trying to make money, that is a massive problem. I don't really see that happening. If the U.S. consumer, they say, well, they have to sell to the U.S. consumer. If the consumer's worse off, you're like, well, they might be worse off, but maybe they're going to go sell more in a different country. Well, aren't those earnings less because of all the tariffs? Maybe, yeah. But they're still going to try to make as much money as they can. And this is not the first obstacle that businesses have faced. And so I think kind of going back to like these narratives of the economy is looking bad. And look, to be clear, actually, the economy is showing some like mild signs of strain. What does that mean? Nobody really knows, because some economic data doesn't read out the same way it used to. It all goes back to earnings. And that doesn't mean that you can't have temporary declines in earnings. But generally speaking, as long as you think companies will keep trying to make money, earnings have historically grown more than inflation. A lot of that's because when there's inflation, the businesses pass on the price increases and then boom, you got higher earnings. Well, then it's a matter of, well, some companies earn more than others because new markets are created. Think of like NVIDIA. So AI, like the chips that are needed to run AI programming, those were a market for the last like 10 years, but boy, did they become an important market in the last year or two. And what's pretty crazy about the stock market is less than like 5% of stocks drive all the returns basically in any given year. And so it's not that every company is going to needs to do well. And maybe that's something I should have led with. You get me talking long enough, I'll get to the points eventually, but let's just go strictly with tariffs. There will be winners and there will be losers. But the winners might win so big that the losers, it doesn't really matter. They might more than make up the earnings lost from some of the smaller companies. And oh, by the way, like some of these losers in the total stock market make up like less than 0.1% of it. So it's not to say there won't be winners and losers. It's not to say that there won't be winners and losers in the real economy. And those are real concerns. And I feel really bad for a lot of people who this impacts. And I'm going to say this, I hope the audience doesn't take it the wrong way. I mean, one of the things about the policies recently, as well as all of the policies since the great financial crisis, are that if you are an owner of financial assets, you're probably in pretty good position. So does that mean it widens the inequality gap? I'm not an expert in this space, but my intuition would be yes. If you're worried about being able to meet your own financial goals, I would say that as long as you're a holder, because again, we're just trying to outpace inflation here. That's the first principle why we're investing. If you have financial assets, a lot of these things are, maybe your assets won't grow 15% a year like they did for a while there. That was unusual. That was not normal. But yeah, you're probably going to be okay long term.
That's always an interesting one to touch on, Peter. I've struggled with it as a content creator over time, whether it's writing or podcasting, where we do notice things where we say, boy, this particular tax law is probably going to benefit, it might make wealth inequality worse. Or there's some things I know in like the financial independence movement where you say like, wait, you could retire with millions of dollars, artificially show very little income and get totally free healthcare. I mean, the answer is yes, you can. It's difficult for us in our positions to fundamentally change policy. if someone wanted to ask us, we're free to give our opinions there and say, yeah, these policies aren't necessarily fair. But at the same time, if our job here is to give the best advice we can to the individuals listening, yeah, there's something to be said where people who own income producing assets have tended to benefit from that ownership, potentially to a disproportionate amount. Okay, but still, you're better off owning them than not. Maybe we'll leave the philosophical discussion to another podcast or another episode. Here's a quick ad, and then we'll get back to the show. Every week, I send a quick free email to thousands of readers that shares 3 simple things. 1, my new articles and podcasts. 2, the best financial content of the week from all over the internet. And 3, a financial chart that explains some important concept in the news that week. It's a great primer to boost your financial know-how.
But Jesse, I don't want another email.
Well, this might not be for you, but I do hear you, which is why I make it very short, sweet, and full of only the essentials. A whopping 66% of subscribers read my email at least once a month. They're enjoying it, and maybe you will too. You can subscribe for free on the homepage at bestinterest.blog. Again, that's a free, no strings attached subscription at bestinterest.blog. On the topic of recession, the one thing I wanted to touch on with you, and again, neither you nor I are PhD economists. You might have. You must.
No, definitely not PhD. I got a major in economics, but I don't think that even makes me remotely an economist.
But at least you...
That makes me a college graduate, yes.
You can speak to this question probably better than I can, though, which is, I think some people through lucky circumstance last week, I got quoted in the Wall Street Journal, which was, wow, big honor.
Very cool.
And the article was about recessions and the fact that millennials might be, as you alluded to, some of the data is looking a little weak, and millennials might start living through what's our third recession. The first one being the Great Financial Crisis, which was like potentially one of the worst recessions the world's ever seen. The second one being COVID, which reminded us that, right, anything can happen and pandemics are real. And now a third one might begin. But the question I have for you is, does every recession have to be a great financial crisis or come along with something like a global pandemic? Or is it possible to have a more vanilla recession?
Well, it's a great question. It's one of the reasons that a deep understanding of history, economic and market and financial history can be so helpful to so many advisors and even individuals who have lived through these periods. Either were at a point in their lives where they had less money and didn't care, or they've forgotten, or they never really realized what was happening in the first place. And so recessions take on all shapes and sizes. And there can also, just for the record, a recession doesn't mean that there's a bear market in stocks, and a bear market in stocks doesn't mean that there's a recession. A bear market tends to precede a recession, but like 2022 is a great example. Had a bear market in stocks, no recession alongside with it. You kind of had this intermittent weakness in different sectors of the economy. There was a really good term for it that's escaping me at the moment, but that's okay. So I think a recession doesn't have to be a crisis. Recession, to me, I think if you're going to try to simply categorize it, you think job loss. So recession, you're typically going to see a lot of job loss. That can bring some real life implications and really shape what your worldview is. So if you mentioned a millennial, if this is your third recession and you lost your job in each one of them, you're going to be really afraid of recession. If you're a millennial who did not lose their job in any of the recessions and maybe even got to invest opportunistically, you're also going to view recessions in a very different light. Mm-hmm. I think when you are thinking about recessions, to me, it's less about your portfolio and more about your balance sheet. And I tend to think of the two things differently myself, in part because my portfolio is so boring. I mean, I already kind of referred to it. I own one fund that's 100% stocks. I don't have any taxable dollars, it's just my business. One day I aspire to have taxable dollars again. But, in general, my balance sheet has different risks in a recession than my portfolio does. Mm-hmm. My portfolio is all retirement accounts at this point. So I don't need the money. I'm 40 years old. Let's say I don't need it for 20 to 30 years. A recession has zero impact on my portfolio. A recession on my balance sheet is a little different. I have some leverage tied to the commercial loan for the business that I own. My cash levels, like my business is kind of tied to the stock market. So if the stock market's down, my income's down and my cash levels are low. And like suddenly I have to think about balance sheet management a little bit more. I'm just kind of talking about my own situation, but if you're listening to this, think about your balance sheet. Think about the cash that's on it. Think about the long-term liabilities, whether it's a mortgage or student debt or some kind of commercial loan. Think about your portfolio, both retirement assets and otherwise. And how would a recession, how would a change in your income stream impact your balance sheet? And I think, if you're near retirement, it could a lot. And I think that's a very valid concern. I won't make it sound too draconian, but like a less than ideal scenario for somebody about to retire is that the first year that they're in retirement, there's a down market. It's not the best thing to have happen because you have to withdraw from your portfolio and you do permanently impair the portfolio's earning potential by doing that. So what you might do if you're going into retirement is start building up a cash reserve so that if there is a recession, one, it won't delay your retirement. So I've seen that happen before where people are like going to retire in a given year and then there's a recession. So they hold off retirement for another 6 to 12 months. Well, like, look, you don't get to push out your life expectancy to 6 to 12 months. So I view that as not good financial planning. I view that as a missed opportunity. And so like having the cash to live through your first recession without needing to draw through your portfolio is a really good preparation point. Doesn't have to be something that's built overnight, but I mean, it could depending on the way that you retire. If you have pensions, you're a little more recession proof. If you're below the age of 50, your portfolio is probably recession proof. And when I say recession proof, not that it's immune to losses, but like you really don't need to worry about it. And so again, kind of going full circle back to my original statement, I tend to think more about how would a recession impact my balance sheet than my portfolio. And if you are retired, I think the same is true. Like, yes, you should have a portfolio that is built that assumes that you're going to have downturns, again, with a similar magnitude and frequency as you've had in the past. And so you've tested it in a Monte Carlo analysis that shows, yes, I can make this withdrawal in a down market. You should be good. Now it's just a matter of managing the rest of your life. You don't have to worry about losing your job in retirement because you don't have a job. Do you have to worry about your kids losing a job and how you might respond if they do? These are the things that I would be talking about more so than, is my stock bond allocation right? Should I have more international instead of more US? Do I need to make changes to where my cash is held, et cetera?
I want to touch on one of those things you said right there, but real quick, you did mention the sequence of returns risk. So listeners, I want to point you to back on episode 87, we had a deep dive on the sequence of returns risk that's worth checking out. But right there, Peter, you just mentioned, one of the questions you might ask is, should you think about your international versus domestic holdings? The last question I want to pepper you with today, as far as 2025 so far, has been this interesting, at least short term, maybe it'll stay, short-term change in international versus domestic stock returns. What have you seen out there? What kind of conversations have you had? I know I've had some, going back to the news narratives, I've had some people who, especially in the downturn of April, said, well, let's just go 100% international now. So I thought that was a fun conversation to have. But yeah, what are you seeing out there?
Yeah, what a reversal from like the past 15 years. So for context, I started my career in the summer of 2007. And basically every year through the financial crisis into like 2011, 2012, when the US debt was downgraded by S&P for the first time, everyone was obsessed with owning more China. People did not want to own US. US was the worst. We should own all international, more international. The past 10, 15 years, people have said, why do we own international? We should only own US. And Jesse, I had my first conversation with a client a few weeks ago saying, I want to shift from the US to international. So it's finally happening. We're finally here. I'm thinking, gosh, I can't wait till international outperforms so that I can stop having this conversation. But silly me, I forgot that then people just want whatever's outperforming. And I'm not making fun of anyone listening who feels that way. I mean, this is just our job. It's hard not to laugh at it. And I think in general, let's go to the simple, why do we own international? There can be different reasons. I'll tell you why I own it, Jesse, is I own it for diversification. I don't own it necessarily for higher returns. What is good about diversification mathematically is if we have two portfolios with the same return and one has lower volatility and one has higher volatility, the one with lower volatility is going to compound at a better rate and as a result have a higher compound return. And that's like your real life money. You want high compound returns. Your average return that you see, on Morningstar of a fund doesn't really matter. What did it compound at? So if the two returns are the same, but one is lower volatility, you want the lower volatility one. And that's what diversification does. Now, in reality, you do give up a little bit of return by owning a global portfolio versus just an all US portfolio. But the corresponding reduction in volatility is great enough that that compound return is attractive enough to diversify. So today, when people are thinking about like, should I switch from one to the other, you're kind of remembering why you do it. And the research will show that you get that diversification benefit, that reduction in volatility benefit from owning anywhere between 20 and 50% non-US stocks. The problem with the research is nobody knows what the magic number is. And so I would tell you, you pick a number and you just stick with it. Like if I were a gambling man and I had my gun to a head and I had to bet what's going to have higher returns over the next 10 years, US or international, I'd say international. But you know what? I would have said that each of the last like 4 or 5 years too and been wrong. And so I'm a really big proponent of pick a percentage and stick with it. Now, let me share one other quick narrative because I know we're running long and I apologize. I'm a wordy guy. I remember being at my former firm, the year is 2011, and we're looking at the return data set. And from like the MSCI data starts in 1970. And so like 1970 through 2011, the returns of an all US portfolio were identical to the returns of a global portfolio. And so we increased our international allocation, and all the reasons showed that we should do it at the time, but then you fast forward and wow, did we make a bad decision? And actually, a friend of mine who has a similar role at a firm, similar size as us, did the complete opposite. This year, they had been overweight international for so long because the valuations suggest, much like I just said, that international should outperform. They had been overweight international forever, and then they switched to overweight US at the beginning of this year, like the exact wrong timing. So you find a percentage between 20 and 50% of your portfolio and don't change it. We happen to be at 30%. Why are we at 30%? I'll be honest, Jesse, this firm was started over 40 years ago. I don't know why we did it, but I'm in charge and we're not changing it. Is there data that could make me change my mind? Of course. You give me 200 more years worth of data, which I know I can't have, but like, let's say I somehow magically could. I'm open to changing my mind, but I think I've now watched too many instances of the timing getting wrong. We already know that we can't predict the future. Why would this situation be any different? And so if you're sitting in your globally diversified portfolio thinking that you want to move more into international or even go all international, even if you're right, you're going to have to figure out when to switch back. And chances are you're going to be wrong. Not because I'm making a prediction, but just because like we are all terrible at timing the market.
Peter, you are always a treasure trove of good investing thoughts, and that answer is just another example of that. 2 final questions for you. One being, let's let the listeners know where they can listen to you on a more consistent basis. But then the second one being, remind us a little bit about the timeline and the topic of your book that you're working on right now.
Okay, well, yeah, thanks for the invitation to share. So my podcast is called The Long-Term Investor. So you can go to thelongterminvestor.com or you can search The Long-Term Investor in your podcast app. I did double check the URL I shared earlier. If you would like a free copy of the book, I don't have unlimited, but I am looking at a box right now of like 30 some. You can go to peterlazaroff.com/free book. The new book, oh my God, I'm going to give you another URL. The new book you can learn about by going to, drumroll, theperfectportfoliobook.com. It is due out, I think, in July of 2026, but that last URL I shared, if you sign up for that, you are not on my normal email list. You're going to get early access to chapters. You are going to get some special offers for like signed books. There's going to be some subscriber-only webinars and whatever else my marketing person comes up with between now and then. I'm going to do a lot of behind-the-scenes stuff so that you can get a sense. I know when you sign up for the newsletter, like the outline of the book is the third. You get 3 automatic emails over 3 days, and then you get on a regular update. But you get an excerpt from a chapter pretty quickly, and you get the outline of the book. And I'm going to share chapters as, in full when they're truly like publisher approved and done. And so, yeah, would really appreciate anybody checking that out and follow along. And, just like on this podcast, you comment, you subscribe, you like, you follow. Those are like what help other people who are passionate about these topics like you. You're listening to us right now. It means you're passionate about this. When you review like Jesse's podcast or you review my podcast, it helps other people like you find us. So we both appreciate when you do that.
100%. That's totally true. Well, Peter, thank you again for stopping by Personal Finance for Long-Term Investors.
Yeah, Jesse, thanks for having me.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.